Hello and welcome to the channel. We spoke in the previous video about the CPI number, that it was the highest since 1982, and I mentioned that the PPI, Producer Price Index, is as important as the Consumer Price Index, and as expected the PPI is 10% higher. That means that the inflation in prices is here to stay. Let's read Lisa Abramovich Bloomberg article about the US real hourly earning is very important. One of the most important chart from this week's data consists of real wages, which are deeply negative as wage fail to keep up with inflation. Here you go. Workers are demanding higher pay and will continue to do so as they see the spending power of their paycheck declines. Da-da-da-da. So if we link the dots, we have a higher CPI number, we have a higher PPI number, and we have the real wages are dropping. That means the purchase power is getting destroyed and will push individual into more debt, not only for a daily transaction for buying food and filling gas, but also to margin debt in the stock market, because it turned out that many retail participate in the stock market using margin account, YOLOing stocks as it shows into this article. The rising amount of debt is concerning, but more worrisome is the percentage of stock market value that the debt present. Margin debt is currently at 2.4% of the S&P 500's aggregate market capitalization of 38 trillion. Just before the pandemic, it was at roughly 2%. So it means during the pandemic, people start participating in the stock market using margin account. Let's continue. To be sure, the current level of margin debt relative to the stock market's value is still below its high. The 3.5% that reached around the time of 2008-2009 financial crisis. What they want to tell us here, that in case this margin debt keep on rising till the point it reached 3.5%, we will have a stock market crash. The lowest point since the mid 1990 was below 2%, and here they given us the lowest point where the market will not be threatened by a crash because of the margin debt. Let's carry on. In any event, the combination of rising margin debt and slipping stock prices augment the risk to the market. When the value of the shares a trader purchases on margin falls to a certain point, what the broker do? The broker that lent the money demand that the trader deposit additional cash in the account. This is known as margin call. Either the trader has the money available, or he or she must sell the stock to raise cash. That means if they will not deposit the cash in their account, the broker will go ahead and sell their stocks. And with selling their stocks, the prices of stocks will drop to raise cash, and will cause eventually a market crash. And then let's combine that with the Fed is definitely going to rise interest rates, and the market is feeling this will happen. For example, hear what Jamie Dimon, the CEO of JP Morgan Chase, said. Expect more than 4 rates increased in 2022 and a lot of market volatility, says JP Morgan's Dimon. If we're lucky, the Fed can engineer a soft landing. This, as you and I know, we have to follow the path of value investing and stay away from the high multiple name and zombie company that doesn't have a product, not even a good balance sheet. Guys, the game has changed from last year to this year. Now we have to be careful where to step. No one want to land on a mine and blow up his account and lose all of his investing. With that being said, let's start with our market coverage. And here you go, the Dow Jones is down by 176.70 point, or a decline of 0.49%. The Nasdaq got it very hard on the chin by a decline of 381.58 points, or a decline of a whopping 2.51%. The S&P 500 is declined by 67.32 points, or a decline by 1.42%. Let's move on to the heat map, and if we see a technology, it's a bloodbath except of value names. If we see communication service, same theme. High multiple names down, value names outperforming. Example Verizon, AT&T. Consumer cyclical, same thing. For example, Ford outperforming. Tesla is down big, minus 6.75%. And the theme is the same all over the map. Let's take a look at the sector performance. We see that nothing is performing, with the laggers of the day: technology, consumer cyclical, and communication service. Let's take a look at the futures. Energy is performing except of natural gas, which is having a lot of volatility because of geopolitical event. Typically the Russian US talk that is failing, and the worrisome that Russia will invade Ukraine. Softs: coca, cotton, orange juice, coffee, lumber, all of it on the green side. Sugar is on the flat line. Metal: gold, silver, on the flat line. Platinum a little bit up by 0.21%. Copper is down, palladium is down. For the meat, live cattle and feeders are gaining, while lean hogs are on the downside by a decline of 0.95%. Grain is down except of canola, with a slight gain of 0.52%. Let's move to the charts, and let's start with the SPY. Yesterday we spoke about the bear flag, and here we go. The bear flag is playing to the downside with this big fat declining candles. We see that the MACD lines are pointing down with the persisting red impression in the histogram, so we expect more pain in the SPY. The Qs got it very hard on the chin. Let's move to a lower time frame, the 30 minutes, for more information and more clearer view. Here we go. This is the bear flag, and the bear flag did play to the downside, and oh boy, the next support will be down here at 369. We see the MACD did cross and are crawling down with the red impression in the histogram. We reach overbought territory on the RSI, but we see here with this volume candle is pretty huge at the end, and this may indicate more pain to come in the Qs. Let's move to the IWM, the small cap ETF of the Russell 2000. same thing. The bear flag did play to the downside, a little bit more area than the Qs and the SPY, and that way I know that the SPY and the Qs, they will not act, or they will not perform that well as a leading indicator was mentioned, was printed by the IWM. Let's take a look at the dollar index. The dollar index breached the very important support of 95. The MACD are crawling down. The RSI is also crawling down, and this is indicate a bearish outcome, and the chart has more downwards direction. Let's move to the VIX. For our chart, the momentum didn't finish to the upside, and we see that it's building momentum. The crossing on the MACD lines and the green impression on the histogram indicates that there will be more upward movement, maybe till 24, 25, and this will indicate more pain in the SPY, the S&P 500. Let's take a look at the government 10-year. We reached the support of 1.7%, and from that we bounce back to a higher level. We have a resistance at the 1.77%. Gold is building a bull flag and is consolidating under the resistance of 1,834. Therefore, the next few days, we look at the histogram, we see that the lines are crossing and there is a green impression of on the histogram, on the MACD histogram. So this consolidation will be for a while under this 1,834 dollar level. Basically, as we know, this is a very important resistance, and the fact that the chart is knocking on these doors 1, 2, 3, 4, and maybe for the 5th time, we will anticipate that this is bullish, and we will definitely this year will have a run up on the gold. Apple stock did build a bear flag, and then we see now that the bear flag is playing to the downside. We have a support at 167.45. If this will, if the chart will reach the support with the MACD histogram is indicating that more pain to come, there is a big chance that Apple will breach the support and go to lower level. Tesla, same thing, bear flag playing to the downside, and we have a support on the 995 level. So if this support will maintain, Tesla may go to the upper level. If not, it will breach and may go down till the 880 level mark. Until now, we see that the RSI is topping here, and the green histogram of the MACD start disappearing and building the red impression with the crossing on the MACD. So everything is telling that the chart is bearish at the moment. Let's take a look at AMC. AMC with the bear flag did play to the downside, is down big. Let's move to the 30-minute time frame to see the magnitude of the drop, almost 10% from 22 till 20 the level mark. We have a support at the 20. Let's take a look at Bitcoin. Bitcoin doesn't look good at all after this bear flag, and we see here a technical pattern of head and shoulders. This is the first shoulder, this is the head, This is the second shoulder, and basically the chart will play to the downside. So finally, let's take a look at the economic calendar for Friday, January the 14th. We have the retail sale excluding autos, the import price index. This is maybe one of the important index for the day. The industrial production capacity utilization at 9:15 a.m. The consumer sentiment index, preliminary also, this is worth a look. The business investor, and the New York Fed President John Williams will speak tomorrow. That's all what I have for you today. Thank you for watching. Thank you for listening. If you find what presented on this channel helpful, like and subscribe to improve the algorithm, and follow me on social media.